Hello out there to my Facebook friends, clients, and the like. I'm Jonathan Bangle here, host of Naked Tax Talk, where we come together and get naked and bear down to the naked truth about our lives, be it personal development, business development, or financial development. And I was supposed to have a guest on today. His name is James, and we were going to talk about websites and what it means from a tax perspective and what it means to build your business. And unfortunately, he isn't feeling well. So, James, I want you to know, if you're watching this from your bed, that I am thinking about you and that I ultimately wish for you to recover speedy, quickly, so that you can get your butt on my show so we can have an amazing conversation and share some amazing knowledge with the peeps out there. I also like to give thanks out to Janet Hernandez of Think Dapper, who helped me with my overlays right now for my show. And so you can notice I have some new overlays here and then down over here. So this is pretty cool. So I got to give her some shout out and some thanks. And today that means that I'm also driving solo. So what I wanted to kind of go over with everybody else is another thing is that I'm trying to make this a very interactive program. So if you're watching the show and you have some questions that come out as I talk, feel free to ask, and then I will engage you and see if I can get you some answers. So this is a great opportunity for you if you're a business owner, even if you're a tax expert and you want to share some knowledge and expertise too. This is a great platform for you to ask some yearning burning questions like a really bad STD, and you can think of me as a really good cure. So with that further ado, I kind of wanted to mention something about the PPP and the EIDL. So here we come again. We're going to talk about the EIDL and the PPP. And I wanted to share a couple of things, if I may get a little nerdy with you guys out there. So what I'd like to get a little nerdy on is to talk a little bit about the word accounting. And what does that actually mean? So accounting is this has been really old profession, right? And it's where people like myself take joy in taking people's information, their raw data. Typically, we all like it raw sometimes, and taking the raw data and then putting it into some type of system, some type of tracker, some type of worksheet, some type of online program, and then we spit out something called financial statements. And then from there we take the financial information and we actually read it. So believe it or not, people who have accounting degrees specifically, like myself, who got a bachelor's degree. First in his family, by the way. First in his family that I'm aware of that graduated high school. First in his family to get his bachelor's degree. And now the first also to get his master's degree. So I've done all this kind of fun stuff. But here's the thing. When you're an accountant, and that's what your degree is in, they actually train us and teach us how to read financial statements. Like it's almost like you're reading a book, except that you're looking at numbers and they're telling you a story. So with that in mind, this is what accounting actually does. And the real value of an accountant comes from their analysis of the data that they're seeing. It's being able to tell a client, I noticed that you're paying a lot in interest expense. What that tells us is that we are funding a lot of our activities and we're not paying our debt quick enough. It's going to be things like looking at labor and saying, well, based on your industry, this is how much money you would spend typically. And we notice that you're overspending or maybe you're underspending, and that's an area for growth. So that's really what an accountant does. And the reason why I bring this up is because I've been asked this question. Then in the world of accounting, you can split that up into a little bit more, and you can go into this thing called taxes. And that's really what I ended up branching into, was into the world of taxes. And why I wanted to get involved with taxes, believe it or not, happened because I myself went to go file my very first tax return. I think I was 17 or 18 years old. I was working at, I think it was Burgers Bagels or something in Tucson. And I went to go file my tax return. And I, for some reason, thought that they didn't know what they were doing. There's a lot of people out there that think this. And so I turned around and I actually studied and started applying what little knowledge I knew, and started just kind of reading on it. And little did I know, I would end up becoming an accountant and specifically specializing in taxation. So when it comes to taxes, we are often faced with the conundrum of what can I and can I not do? Here's the thing, right? Like taxes is constantly in our lives. It's affecting us at our personal level and it's affecting us at our business level. This is what taxes do. Taxes incentivize us and de-incentivize us to take action on various things. For example, with the PPP loan and the EIDL loans that came out of the CARES Act, we were all incentivized to go out there and find ways to temporarily put money, put cash into our business. And I was a big proponent of it. I still am. I still believe it's necessary and something that businesses should do. But there's a little bit of a catch. And the catch is, and I actually thought about this because as an accountant, someone who analyzes numbers, somebody who constantly is asking the what ifs and the how to's, I actually took a step back and I said, well, if they're going to give us this loan, all right, and they're going to call it forgivable, so the PPP is technically forgivable. The EIDL has a forgivable portion in it covered by the PPP rules. If it's forgivable, then I know from my experience and from my knowledge as an IRS enrolled agent that the government never does something for free. It never does. In fact, it is constantly going, all right, so what I give you, I will take back. Now, here's the thing, and let's understand this. As an entrepreneur, the IRS, the government, is not out to punish you. Let's be very clear. They're only out to make sure that you're following their rules, and oftentimes their rules are for your benefit if you know how to play inside of the rules. So when I saw that the PPP and the IDL was going to have a forgivable portion, I asked myself this question, which is, okay, so now here's the thing. When something becomes forgivable, debt specifically, it is actually called income. This is what happens, right? Think of this for a moment in accounting in general. So accounting is going, if I do this, then I must have an opposing force. Plain and simple. It's kind of how it works. So if I give out money, all right, and I forgive it, okay, something has to happen over here. So what happens over here on this side is that the government actually sees the forgiveness of debt as income. It legitimately says, well, au contraire, mon ami, that is actually income to you, and you need to report that portion as income. Now, I'm not saying that the PPP and the EIDL is income to you. I'm not saying that at all. So even for my experts watching the show, please don't get confused that I'm not saying that this is income, because it's not. It is a loan with something called a forgivable portion in it. But the rules state that if something is forgiven, then it becomes income to the taxpayer. Now, this isn't necessarily what's going to happen with the PPP. There's something else that's going to happen. And in a minute, I'm going to explain what that something else is. So right now, you're going to get the PPP. And so they're going to forgive this portion. Now, you see why you want somebody with an accounting degree to work with you on this matter is because we fundamentally understand a concept called debits and credits. You see, when you go and get your accounting degree, the first thing you learn is something called debits and credits. It forces you to change your thought process in the terms of adding and subtracting. We take the word adding and subtracting and replace it with the words debit and credit. And when you take debits and credits and you mix them together, you get fun things that happen to them. So needless to say, when I saw the loan portion, the PPP coming in, for those of you who are actually visual learners, let me go ahead and pull this up and I'll share with you. So I'm going to try to share my little lovely notepad. Here we go. So for those of you that are visual learners, here we go, right? So in the accounting world, we have this thing called debits and credits. So what we're saying is that for every action, there must be a reaction. And so if I take in, by the way, those of you who are my accounting experts, bookkeeper experts, you'll know what I'm doing. I'm creating something called a T account. So under the credit, this is what happens is you get the PPP loan, and we'll call this the PPP loan. Okay, so what happens is that in a journal entry in accounting, the way it happens is we see a $10,000 deposit being made into my checking account because that's what was advanced. And so you will see that on one side of my T chart, I've listed 10,000, and then on the other T account I created, I have something called a credit. They balance each other. It's like being on a balance, right? So here you go. Here's a balance. It's all about balancing. So it has to go somewhere. So what we're going to do on the back end, and what you're going to do out there if you do it yourself, is you're going to track the PPP loan or the EIDL loan as a loan. It's originally going to be treated as a credit. So it gets credited And then you're going to have your bank account typically going to be debited, right? It's going to increase your cash, and your loan, of course, is going to be increased because it went from 0 to 10,000, let's say. Now, here's the dealio milio. When government says it's forgiven, the money will be spent already. So we're going to spend $9,000 in our example. We're going to spend $9,000 on labor. And so I'm going to create another T account called labor. And I apologize for some of you out there that don't know what the hell I'm talking about. But again, I'll reemphasize that I'm drawing T accounts. This is how we learn accounting, believe it or not. So if you want to learn the basics of accounting, you're going to get a little bit of that right now. So needless to say, I have $9,000 that's going to come out of my checking account, and it has to go somewhere, right? So it's going to go towards something called wages. Let's say it's call it labor, and it's going to pay $9,000, right? Now notice that my new balance over here becomes $1,000. So essentially what I'm doing is I'm taking 10,000 minus 9, and I'm getting 1,000 left over in my balance. I have $9,000 in my labor, which is a debit, and I'm balanced. Everything's still balanced. As an accountant, as a Libra, as somebody who has to have multiple lovers, I'm very balanced, and we like that. We like the Zen. You know, if you were trying to be in the moment, Buddha's teachings of being in the moment, being centered, in a way, accountants are naturally that way, I think, because we're constantly trying to find the balance between the positive and the negative, between the credits and the debits. So anywho's blues, that's a terrible attempt at a joke. So my point is that now you still have this $10,000. So the government's going to come in and they're going to say, so my little taxpayer or big taxpayer, the $10,000, you used it correctly. You spent it on wages, you spent it on rent, you spent it on utilities, spent it on the mortgage interest portion only. So bravo. So now we're going to forgive that $10,000. So all of a sudden, I have to account, because the accountants have to account for this, you see. They go, oh shit, I got $10,000 sitting on a loan that's now become forgivable up to the portion that I used correctly. So in a way, it's kind of like algebra, because you have an equation where you've got something that is kind of like, and I apologize because I have not done school algebra in a long time. I just do it in my head as a second skill now that's just there. But so essentially what I'm realizing is that I've got to move $9,000 out of the way. So I've got to go from $10,000 and subtracting something, the value of A, to equal $9,000 or something like that. I don't know if I can do this correctly. Never mind. I'm not going to try to teach algebra. I'm not a math teacher. I refuse. I just know this became a skill set that I had to spend many freaking years to learn, and I did it. Hey. So needless to say, let's back up. So next thing you know is you've got $10,000. Our government says you used correctly $9,000 correctly of the loan portion on labor. So we booked it as wages. Now it shows up as wages on my end. But Uncle Sam says, you're good. Yay, you did it. You spent it correctly. So it's not a loan anymore. $9,000 is not a loan anymore to you. So all of a sudden, I've got $9,000 that I'm going to account for on the loan portion, and I'm going to debit the $9,000. Okay, so the T account's got to be in balance, which leaves a remaining balance of $1,000. Okay. But I've got to do something with this $9,000 entry. By the way, I'm going to label this as 1 and as 1 so we can track this easily. So 1 to 1, we'll call this a 2. We'll call this a 2. So you can see how they each tie out to each other. So now you got $9,000. I'm going to forgive you. IRS says that if I forgive debt, then the person that I'm forgiving the debt to becomes taxable income to the individual or to the taxpayer. Could be the corporation or could be you. And so now all of a sudden I've got $9,000 of income. But see, here's the thing though, they're not calling it that. They're not saying it's income to you. That's what they're not saying. What they're instead saying is you're going to take that $9,000 and you could either call it income, but you're not going to, because for some reason the regulations are not quite calling it that. So you may call it $9,000 with a question mark, but you're not really going to. So instead, the only other place that we can take this credit to, because we've got to use the opponent force. So if I'm debiting on one side, I have to credit on another. So the question becomes, well, where in the hell are you going to put the credit for $9,000? Well, here's what we're being told. Are you ready? Here comes the shocker. So if you've been listening to my show now for 15 minutes, I'm finally giving you the answer. We're going to go from 9,000 and we're going to hit it right here in labor, and we're going to credit it for $9,000. Now, for those accountants out there and for those that are not, please know that when we're using T accounts, we are looking at debits and credits as either adding or subtracting from each other. So in this case, if I've got 9,000 minus 9,000 equals $0. Okay, equals $0. So what that means is that I've effectively washed out my deduction. Now, why is that important? Well, when you go file your tax return, you're going to tell Uncle Sam that you paid $9,000 in wages. Okay, you paid him $9,000 out in wages. So normally what happens is, if I may skedoodle forward, I guess, is that a word? I don't even know if that's a word. Can I even get this thing to go down? Let's see here. I can go this way. Can I go? Oh, I don't know how to operate this thing. Oh, well, ni modo. We'll go to a new page. So what happens now is normally in a normal tax situation, okay, so a tax situation normally is you would have income as a self-employed individual or as a corporation or whatever. And let's say that in a normal situation, so normal, you would say that you're bringing in, let's say you brought in, let's say that you brought in in our demonstration, let's say you brought in $20,000 in gross revenue because you provided a service or you sold some product. And normally I would have deducted $9,000 in labor costs, right? Because I used this, that's what I had to pay out in wages. Let's be real, right? It's what I'm paying for labor, taxes and labor and wages and whatever else that's included in that. Well, if you remember from this little worksheet, so let's see if I can recall it. I don't even know if I'm going to be able to. There we go. If you recall from here, they're going to forgive $9,000, and the accountant is going to book the $9,000 from being a loan, and it's going to offset it against whatever you use that money for. In this case, we're going to say labor. So by doing that, I essentially have to add back in the $9,000 that is the forgivable portion. Now, if you're doing math and you're looking at just this part right here, and if I take a positive 9,000 and a negative 9,000, using our math skills, we know that the net effect is 0. So now when I take my $20,000 in gross income and I subtract 0 from it, I get $20,000 in taxable income. I'm going to write that out because I can. I'm going to get $20,000 in taxable income, and it's going to be subjected to taxable taxes at that point. So you see, every single one of us, including me, we were in a rush to go out and apply for the PPP. We were in a rush to go out there and get the EIDL. We were so hot and bothered over it. It was kind of like everyone got told that the hottest new piece of meat just walked into the bar, and you had to go take a piece for yourself, without realizing that there would be consequences to taking a piece of that new meat that just came in. And that's kind of what happened with the EIDL and the PPP. Everyone, including me, got excited and went out and got the funding. The question I always asked myself in the back of my mind was, what's going to happen when they forgive it? So right now, the way the law is written is Congress did not address this issue. They've not addressed the issue of this forgiveness portion being taxable to you, in effect, as income. In effect, as income. They're not calling it income, right? Because that's not technically what it is. It's a loan, but it was forgiven to you. And because it was forgiven, it's now considered income for tax purposes. But how does it work? Because it's washing out where you spent the money. And so it's washing it out. So I'm going to tell you guys all right now, I'm going to be here in the forefront of this on May the 6th, 2020. For those of you that are listening later or watching now, please know that when you go to file your taxes in January, February, March, April of 2021, and you're doing this yourself, or you're not talking to your tax preparer, or you're not talking to your proactive tax planner like me, you may find yourself paying a higher amount of taxes, potentially, especially if COVID had a positive effect on your business and your revenue went up through the roof. Now, the argument could be made, JB, I had a shitty year for 2020. COVID completely trampled my business, ruined my revenue, sucked me down dry. Um, like, okay, then. So maybe from a planning perspective, we're not worried about this effect. And maybe, just maybe, when Congress wrote these laws, the CARES Act for the PPP and the EIDL, maybe, just maybe, they were not considering that people would actually have profits at the end of 2020. So maybe that's their argument why they didn't address it, why they didn't put it into the law. Because I'm telling you all right now, you're going to take your PPPs, you're going to take your EIDLs, the forgivable portions, and you are going to use it to pay the wages. You're going to use it to pay for the rent and the mortgage interest portion and your utilities. That's what you're going to use the money for. And then come year end, your accountants, including me, are going to have to say, I'm so sorry. But even though that you had $9,000 in labor, the forgivable portion that you used to pay for labor was $9,000. And so, in effect, you have no deduction allowed for the wages because it washes out. So, unfortunately, my dear wonderful taxpayer, your new tax bill is X, Y, and Z. Now, that's going to happen when somebody works on a reactionary basis. You see, when people are reactionary in their business, it catches you off guard. It's like being unprepared. It's like walking into a bathhouse without rubbers. It's walking into a place that you're unprepared for. And that's kind of what this created. COVID caught us all off guard. I think we can all admit to that. Of course, I mean, no one could have predicted this. It also no one could have predicted the outcome of what Congress was doing at the moment they were doing it. Because let's be real, Congress and the White House were pushing through our packages, our aid. They were pushing it through because they also saw the plight of our economy. They saw the plight of our businesses. They knew that. So out of their good intentions, that's just what they did. But you see, with every action comes a reaction. Isn't that the law of Newton? For every action, there's a reaction. So you hastily pass a law, the CARES Act, that gives out free money like candy, which is fine, except that they're not telling you the real truth. In fact, we all kind of assume that maybe perhaps in the regulations, in the law, that they would have addressed this problem, but they didn't. And so here's the thing. Come 2021, when you go file your 2020 taxes, we're all going to wake up to paying more taxes, potentially. Again, if COVID had a positive impact on your life, on your tax life, to be specific. So with that in mind, if you are a little bit concerned like I am, I would be picking up the phone and calling my senators and my representatives, and I would be telling them that they forgot to write in the forgivable portion and not count it theoretically as income to you, the taxpayer, because someone is going to pay for this. Now, here's what I can tell you. When you're reactionary and you go file your tax return, you realize that this is what's going to happen. There's not much that proactive tax planners can do for you. That's the honest truth. There's nothing much we can do for you after the fact. But we can work with you very, very much so in advance of this information. That's the thing right now is I'm actually going through all of my current client situation, and I'm actually taking a look at what their PPP values were and how they're using it so that we can actually advance out our tax really and figure out and calculate what is their tax liability going to be as a result of this. Maybe we have to come up with other strategies, which is what we're working on right now, to ensure that they still get the same level of deductions that they were anticipating anyways, that was not royally fucked up by the forgiveness of the PPP and the EIDL. So this is what's really happening right now, and no one's really talking about it. except for me that I'm aware of. Actually, to be honest with you, it was my really good friend. I was attending a tax update course, Tom Grigorski, who shared this information, and it was a big light bulb. So thank you, Tom. And here's the thing, right? When you work with IRS enrolled agents like myself, this is what the association calls us, America's tax experts, because, tax law is changing moment by moment. And the CARES Act really, really showed that that is very true. That at the drop of a hat, you go from understanding one thing about taxes, and now you have to learn something completely new. So people like me have to go take classes to keep up on it so that I can divulge this information and give it out to you guys. So that's really what's happening, right? I'm giving you a real-time live updates because the truth is we're all going to get caught with our pants down. So the question then becomes, what can you do? Well, quite honestly, you can quite ask yourself, do I really want to use this money for this purpose? Or do I want to take the bullet, so to speak, and use the funds differently and then just pay back the PPP as a traditional loan at a 1% rate to be paid back over 2 years? Um, is that something that I'm willing to do? And again, through proactive tax planning, we would sit down with you and we would decide if that was the right path for you to take, because it's about cash flow now. It is about taxes to a degree, but it's also about cash flow. Do you have the cash to pay back the PPP loan? Or maybe you take the EIDL and you were thinking, well, yeah, I'm going to use it for wages, and yeah, I'm going to use it for my rent. Now that you know that the forgivable portion essentially washes out the deduction, maybe that's not what you want to use the money for. Maybe instead you want to use the money for investing in capital, which again, that's great. It's a gray area because I just read my contract for the SBA EIDL loan, and that was a gray area. So I digress. So maybe you want to use those funds for something else. So that is the reality of what's happening with the PPP and the EIDL. Just like with COVID, we didn't understand the gravity of the virus, right? And so we waste our time pointing fingers and blaming everybody. We blame politicians, and then we blame our friends, we blame our mother, we blame everybody for it. Instead of just looking at it for what it is, which is a virus that showed up and seized the world, like shut it down. And what's going to happen with the CARES Act in terms of the PPP and the EIDL, the fallout from that is going to be the same exact thing. People are going to blame everybody else for what's happening. They'll probably blame the tax preparer or the planners or whatever for them having to pay more in taxes. But here's what I'm telling you, and I'm telling you now. Don't blame the messenger. Don't blame the people that are working with you, because all they're doing is interpreting the law and they're just giving it right back to you. And they're doing it for your benefit. So that's kind of what was at the top of my mind today, was about this PPP stuff, the EIDL, and the forgivable portion. So quite honestly, if you would like to know how you can mitigate the damages moving forward, knowing that the forgivable portion will wash out the expense that it pertains to, unless it's changed by Congress before the end of 2020, let's get naked at nakedtaxtalk.com. And let's honestly have a great let's have a conversation about what we can do. So anyone who's watching now, if you have a question and you'd like to ask your question, please feel free to ask your question. I did make the show short today just because my guest unfortunately fell ill, and so we'll have to stay tuned. But tomorrow, on the other hand, I'm interviewing a wonderful woman named Debbie Peck, her and I, we're going to talk about online businesses and the tax ramifications that it comes from it, and that things are not always free. Just like the PPP and the EIDL, things are not always free. I'm Jonathan Bengal, host of Naked Tax Talk, and we're just keeping it nice and short and sweet today. Talk to you guys later. Have an amazing day, evening, morning, or whenever it is that you watch my show. And I think